Hello everyone and welcome back to the channel. Today, we're diving into a topic that's crucial for anyone looking to build wealth through investing. How to choose a good stock. Whether you're a complete beginner or have some experience under your belt, understanding how to select quality stocks can significantly impact your financial future. Investing in the stock market can be incredibly rewarding, but it also comes with its fair share of risks. The key to successful investing is making informed decisions, and that starts with choosing the right stocks. In this video, we'll cover everything from understanding what stocks are, to analyzing financial metrics, researching industries, and applying both fundamental and technical analysis. By the end of this video, you'll have a solid framework to evaluate stocks and feel more confident in your investment choices. So let's get started. Chapter 1. Understanding what a stock is. First, let's clarify what a stock actually is. In the simplest terms, a stock represents a share in the ownership of a company. When you buy a stock, you're purchasing a small piece of that company, and as a shareholder, you have a claim on part of its assets and earnings. Stocks are often categorized into two main types: common stocks and preferred stocks. Common stocks usually come with voting rights, allowing you to have a say in company decisions during shareholder meetings. Preferred stocks, on the other hand, typically don't offer voting rights, but they do provide a fixed dividend, which can be appealing for income-focused investors. Now, why should you invest in stocks? Historically, stocks have outperformed other asset classes like bonds and real estate in the long term, making them an attractive option for wealth building. However, it's essential to recognize that investing in stocks carries risks, as their prices can be volatile. In the upcoming chapters, we'll explore how to evaluate stocks to make informed investment decisions. Chapter 2. The importance of research. Before diving into specific stocks, it's vital to understand the importance of research. Many investors make the mistake of buying stocks based on tips from friends or social media hype, but this approach can lead to poor investment choices. Research helps you understand the fundamentals of a company and its position in the market. It reduces the risks associated with investing, ensuring that you make informed decisions based on facts rather than speculation. 1. Tools for research. Several tools can assist you in your research. Financial statements. These documents provide insight into a company's financial health. You can find them on a company's investor relations page or financial databases like Yahoo Finance or Google Finance. Company reports. Quarterly and annual reports, 10-Q and 10-K, contain essential information about a company's performance, risks, and future outlook. News outlets. Staying updated on the latest news related to a company or industry can provide context that numbers alone can't offer. Section 1. Understanding financial statements. Let's delve deeper into financial statements, starting with the income statement. This document shows a company's revenues, costs, and profits over a specific period. It's essential to look for consistent revenue growth and profitability, as these factors indicate a well-managed company. Next, we have the balance sheet, which provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. Key metrics to analyze here include the debt-to-equity ratio, which indicates how much debt a company is using to finance its operations. A high ratio might suggest higher risk, while a low ratio could indicate financial stability. Lastly, the cash flow statement details how cash moves in and out of a company. Strong cash flow is crucial for a company's survival and growth, making it an essential metric for investors to consider. Chapter 3. Fundamental analysis. Now, let's discuss fundamental analysis, a method of evaluating a stock by examining related economic and financial factors. This approach helps investors determine a stock's intrinsic value, allowing them to make better investment decisions. Key metrics: earnings per share, EPS. This metric indicates how much profit a company makes for each share of its stock. Generally, a higher EPS suggests better profitability. Price to earnings, PE ratio. The PE ratio compares a company's current share price to its earnings per share. It helps investors gauge whether a stock is overvalued or undervalued. For example, a high PE might suggest that investors expect high growth rates in the future. Debt-to-equity ratio. This ratio measures a company's financial leverage by comparing its total liabilities to its shareholder equity. A lower ratio indicates a more financially stable company. Dividend yield. For income-focused investors, the dividend yield is crucial. It's calculated by dividing the annual dividend paid per share by the stock's price. A higher yield might indicate a strong income investment. Section 1. Analyzing company earnings. When analyzing a company's earnings, it's essential to look for consistency and growth. Companies with a track record of increasing earnings over time are generally more attractive to investors. For example, consider Apple, which has consistently reported increasing earnings due to its innovative products and strong market position. Section 2. PE ratio and what it tells you. Understanding the PE ratio is crucial when evaluating stocks. Comparing the PE ratios of similar companies in the same industry can provide insight into which stocks may be undervalued or overvalued. For instance, tech companies often have higher PE ratios than utility companies because investors expect higher growth rates. If a tech company's PE ratio is significantly lower than its competitors, it might be a red flag or a potential buying opportunity, depending on the circumstances. Chapter 4. Understanding the industry and market. To make informed investment decisions, it's important to understand the industry and market conditions in which a company operates. Each industry has its own dynamics, and economic factors can significantly affect stock performance. 1. Studying industry trends. Analyzing industry trends helps you identify which sectors are poised for growth. For example, technology and healthcare have seen rapid growth in recent years, while traditional sectors like retail have faced challenges. Consider the rise of renewable energy as an example. Companies in this sector are experiencing increased demand due to a global shift towards sustainability, making them attractive investment opportunities. Section 1. Different industries and their cycles. Understanding the various industries and their cyclical nature is crucial. Here are a few sectors to consider. Technology, fast-growing but can be volatile. Innovation drives success. Healthcare, generally stable and less affected by economic downturns. By analyzing these factors, you can make more informed decisions about which stocks to invest in. Chapter 5. Technical analysis. While fundamental analysis focuses on a company's intrinsic value, technical analysis looks at price movements and trading volumes to predict future price movements. Key concepts. Charts. Learn to read stock charts, including line charts, bar charts, and candlestick charts. Trends. Identify whether a stock is in an uptrend, downtrend, or sideways trend. Support and resistance. Understand how these levels can impact stock prices and inform your buying or selling decisions. Section 1. Using indicators. Technical indicators like moving averages, RSI, relative strength index, and MACD, moving average convergence divergence, can provide valuable insights. For example, if a stock's price consistently stays above its 50-day moving average, it may indicate a bullish trend. Chapter 6. Building your portfolio. After choosing good stocks, the next step is to build a diversified portfolio. Diversification helps reduce risk by spreading investments across different assets. 1. Asset allocation. Decide on the percentage of your portfolio to allocate to stocks, bonds, and other assets based on your risk tolerance and investment goals. 2. Diversification strategies. Consider including stocks from various industries, as well as international stocks to further diversify your portfolio. Section 1. Rebalancing your portfolio. Regularly, reviewing and rebalancing your portfolio is essential to maintaining your desired asset allocation. As stock prices fluctuate, some assets may grow faster than others, leading to an imbalance. Chapter 7. The psychology of investing. Investing is as much about psychology as it is about numbers. Emotional decisions can lead to costly mistakes. 1. Overcoming fear and greed. Understand how these emotions can impact your investment decisions. 2. Sticking to your plan. Develop a clear investment strategy and stick to it, even during market fluctuations. Conclusion. In conclusion, choosing a good stock requires thorough research, analysis, and understanding of the market. By using both fundamental and technical analysis, you can make informed decisions that align with your financial goals. Remember, investing is a journey, and it's essential to stay educated and adapt your strategy as needed. Thank you for joining me today. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and share it with your friends. And as always, feel free to leave your questions or comments below. Happy investing!